Hey everyone. Last week, I did a quick little snippet on the Jolla offer that had been offered for the Tetraphase deal. And I didn't get to really look into it. So this week, I'm going to spend some time uh, doing a little bit more of a deep dive and help you understand what's going on there in my view. Check it out. Hey everyone, this is Greg Miller from Spinoff Investing Simplified. I'm your host here at Spinoff Investing Simplified's YouTube channel. And I appreciate you stopping by and taking a look around. If you appreciate this video or any of the others, please subscribe to our channel. We would love to have you along. We also appreciate your comments, and smashing that like button helps us out with the YouTube algorithm. We sure appreciate your time with us and hope you enjoy this video. Thanks a bunch. So we're going to review the Jolla tender offer for Tetraphase, and before we get into it, there's a really interesting article. Well, interesting article. It was a little snippet from Valuate Vantage, and Jacob Plieth had a really cute article title that I think is kind of funny. Tetraphase's love quadrangle sees three bald men fighting over a comb. And bidding wars happen sometimes when we look at tender offers, it seems like, and it's really interesting that Mr. Plieth talks about this, because you have Jolla, Melinta, and SLRX, all three of the companies that are bidding for Tetraphase. All of them have an uncertain future because they all have drugs that haven't really gone very well. And so perhaps the reason why Tetraphase has had such a good chance of having their share price going up for the control of the company is because each one of these companies recognize that they need to do something in order to get out of the quandary that they might be in. So who knows? We'll see what happens with the three. With that in mind, I'd like to just do a little bit of a background with the summary of the different offers that have occurred over the past few months. So the first one came from SLRX, and that was on March 16th, just a couple of days after the coronavirus scare and the corresponding share drops throughout the entire market. SLRX came out and offered stock plus $12.5 million in contingency value rights. So if you don't remember what a contingency value right is, this was a new thing for me. But the contingency value right is basically if Tetraphase's drug, Sarava in this case, performs well, then, and it's based on net sales in this case as well, those net sales would then transfer into additional cash for the holder of that right. So 12.5 in CVRs plus SLRX's stock was what they offered. Well, with all the fear that was in the market at the time, it's no surprise that the answer to that from Jolla didn't come until the 6th of May. And there was a significant amount of fear, not sure if things were going to go through. SLRX might have been a great place to enter because there was so much fear in the market. And in fact, it would have been a great place because if you look at it, it's $2.70 a share right now, or according to this chart that I had on June 25th. And basically you could have bought it for about 85 cents a share, meaning that almost about a triple of your money would have come through with this. Jolla came out on the 6th of May and they offered 22 million plus the 12.5 million in CVRs. And the question is, looking back at it, because I didn't participate in this at this time, is would I have purchased during the SLRX option, or would I have had to wait until the Jolla came out with a $22 million offer? I don't know. I don't know how I would do that. I'm trying, again, this is new to me with some of these tender offers, and I'm trying to understand and make sure that I am doing the work that makes me feel comfortable with the investment. On the 12th of May, Jolla came out with 22.3 million plus those CVRs. Melinta then entered the fray on the 14th of May, 27 million plus the 12.5 million in CVRs. And all the way to the end of May, you have Melinta at 34 million in cash plus 16 million in CVRs. Now, AcceleRx came back and they kept offering cash and stock throughout this. And Jolla finally entered the fray with a double of their original offer of 22 million. And that is the one that I was talking about last week, 43 million in cash plus 16 million in CVRs. Now, the important thing about the Jolla's offer is that they also disclosed that they have almost 15% of the company that they'd purchased over the last couple of weeks. And so their entry price was somewhere between $2, or it was about $2.44 a share on average. They also announced, when they announced that they had this much in the company, that they did not want to enter into a hostile takeover. Now, the ability to do that is pretty high because the inability to do that is pretty high because this particular company, when we think of Tetraphase, they have about 50% of it through some special interest activist type investors. And so this seems to be a pretty heated battle for the company. And the individual that stopped and purchased on the day that AcceleRx came out at that 85 cents a share, or maybe even less, would have almost tripled their money in just 3 or 4 months. So really interesting to watch this. Looking back at it, I think what attracted me to the Melinta offer was the CVRs, and because the confusion is what really makes it so that there's a little bit of a disparity between the actual value of the deal and the value that is currently being quoted on the market. Excuse me. So what I'm trying to look at is, okay, the lesson I am learning right now is that I want to see the special situations with a little bit of flair to them. And in this particular case, if you have the contingency value right that is there, that might be something to really dig a little bit deeper and understand what's going on with that. With that in mind, I went ahead and did a calculation of what it would be, and the $1.48 in contingent value rights, that is, if everything goes perfect, there's the $55 million in net sales by 2024, and in 2021 there's at least $20 million in net sales on the Xerava drug. Well, if that is the case, then the Jolla offer represents $3.48 a share, and there's still some opportunity to make a little bit of money on it. I think it's lessened now that Jolla has disclosed what they have about how much money that they have invested in the company, but it does give you an idea of the opportunity that is there. That same contingent value right option is right there for Melinta. Melinta got 1 million out of Jolla out of Tetraphase, for Tetraphase backing out of the deal. And I don't know, it's really interesting. If you look back at some of the reports, particularly the report about Melinta, there were more companies that have been looking at Tetraphase. So who knows if this is over? And if it isn't over, all the better for me, I would hope. I think the value is probably there. Am I 100% sure? No. And in fact, I think just when you do this type of stuff and you put as much money as you do into some of these things, you have to be very cautious about what's going on and pay attention to what's going on. And who knows? I am slightly optimistic that that'll turn out all right. So we'll see. Continuing in my foray into tender offers and learning more about them, I spent some time this week, and on the 22nd of July, THL Credit offered a Dutch auction tender offer. Now, a Dutch auction tender offer is when the tender offer is a range that the company is offering to the sellers, and the seller gets to pick what price that they want to do. Now, you can do it the other way around, where it's a Dutch auction tender offer for buying securities as well, and you basically name the price that you want to buy it at, and then they sell at the price that they're interested in doing it. The important thing is these Dutch auction, this particular offer, they're trying to get between 15 and 17% of the company respectively. So they have a certain amount of cash. In this case, it's either 10 or 20 million. I can't remember off the top of my head. I should have written that on my slide. That's feedback for me. Thanks, guys. But it expires on the 21st of July. Now, just looking at it at the 1,000-foot level, the THL Credit share price, in my opinion, and this is my hypothesis, in my opinion, will trade somewhere between $335 and $355 in that range sometime during the 1-month tender offer. Now, I would expect that will happen closer to the July 21st date. But if that were the case, I would expect that an entry price below $3.13 a share will indicate at least a 10% low risk return, or around a 10% low risk return for the would-be investor. Now, in that tender offer, looking a little bit deeper, there is a little paragraph that says the most recent quarter net asset value was $5.34 a share, and that was based on their most recent standings back in April. If this tender offer is successful, it will jump that net asset value somewhere between $6.29 and $6.47 a share. So, as an analyst, do we believe that $5.34 a share is significantly, or is it a good price or an actual decent price for the company? Well, THL Credit sells debt, and they have kind of the higher level debt, and they put that debt into their business, and then they leverage it and sell out or hand out dividends. The company is structured as a registered investment company, and so basically, kind of like a registered investment company is very similar to a REIT in structure, where the returns on the company have to be paid out at a certain percentage of the dividend returns from dividend, or in this case, the interest payment returns from the investments that are made. Now, in this case, $5.34 a share, if that is correct, which is post the COVID scare, but prior to any type of significant bankruptcies like our Hertz Holdings and all of those things that have happened recently. And so the question is of that net asset value, how much of that debt is going to turn into insolvent companies? The other thing to think about with this is this company has had a history of taking those times when they have that debt and then transferring it into an equity position on the company that they had the debt in originally. So in my view, even at 70% for that net asset value, which is, I think, a more realistic perspective for this company, the net asset value of this company is somewhere between $4.40 and $4.53 after a successful tender offer. With that in mind, that still shows a significant return, maybe 25% and on up, for the company in this particular case. This is my hypothesis. I don't know how this is going to work. In full disclosure, I have purchased this company at about a $3.17 per share price, and I expect to hold it. Now, how will I play this? I might play it the same way I did with the Ecolab tender offer, and that is I'm going to pull out my original investment, and then if there's some sort of option in the future to just kind of sit on a couple of shares, I might just leave those in there and see how that returns. There's a significant dividend payment that comes out of this company based on the debt that they have. Who knows how this will work? I'm a novice at this, trying to learn how to do it, okay? So be warned, if you follow me into this trade, I am not an investment advisor and I'm trying to figure this out. But if you did like that idea and you've spent some time looking at it yourself, you need to smash that like button, because that's going to make it easier for me to continue to putting up videos like this on YouTube. So smash the like button, subscribe. We'd love to have you along. Thanks a bunch, guys. Now, why have I spent so much time on tender offers over the past couple of weeks? Some people have looked at me and said, hey, I thought you were focused on spinoffs. And I was like, yes, I am focused on spinoffs, but I also have always been interested in all of the different types of special situations. And it seems like tender offers is the next one that I've really started to crack the nut on. The share price for Tetraphase increased significantly during the COVID-19 crisis. Part of that is because of the battle for control over the company. However, this suggests to me that tender offers provide some element of price support or risk mitigation, even during adverse market conditions. So in my view, from what I have seen, it seems like this is an opportunity to make a significant amount of money even when the market is going down or in high volatility, and it's going to improve my returns because it would reduce the losses. That's what I'm looking at. The second thing that I look at is the capital return time. So if I can return my capital in a month, I put in 10,000, it comes back and I get another 20 to 40%. Kind of like I did with the Ecolab tender offer, then that gives me a significant amount of opportunity to do this over and over again. So if I can do it, say 4 times in a year, that's 40% return at 10% expected. If I do it 4 times and one of those is a no-brainer and it does really awesome, and I do it like say the Tetraphase one I got in early, if I'd done that, I would have 3 times the money that I originally put into it. And so at that point, I would have been able to pull money out. I would have had that romance without risk that Maurice Schiller talks about. And basically the equity participation being paid by the market and me being able to just reap some of the benefits from it long term. Speaking of romance without risk, I just had a little bit of a blurb to end this on. You know, there's the upcoming spinoff from IAC, and Match is the owner of Tinder. I've spent some time talking to some of my friends at work about this. If you don't know, I work in the military, in the Air Force. And the funny thing is I say, hey, there's a tender offer. And the first thing that people are saying is they are thinking Tinder offer, not tender offer, Tinder. And they look at me kind of weird because they know that I have a family. They know that I'm pretty conservative in my views. And they're like, oh, I didn't think that you did that type of stuff. And it's just been kind of fun to watch that. So when we think about romance without risk, the upcoming spinoff from IAC, something that's been in the news quite a bit, Match, the owner of Tinder, that's what people are always thinking about when they don't want to spend some time and really understand the special situations in investing. However, if you're interested in learning more, feel free to check me out at spinoffinvestingsimplified.com. I really appreciate your support here on our YouTube channel, and reach out to me if you have any questions. Thanks a bunch, guys. As we finish up, we have one final note for you. This video was made for educational purposes only. Any companies mentioned in this presentation were discussed for educational purposes only. Discussing such companies and the specifics about them is for illustrative purposes only and not a solicitation to purchase them. We recommend that you conduct your own research and identify why you might want to own the company yourself before you commit any funds. We also recommend that you seek the services of a financial advisor that has considered your situation as your fiduciary. May your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks.